The United States just extracted a sitting president from a sovereign nation in 72 hours. No declaration, no negotiation, just action. While the world watched Venezuela, something far more significant was unfolding in the metals markets. Silver broke $80. Gold shattered every historical pattern. And backwardation appeared in markets that shouldn't show stress. 4 consecutive years. 800 million ounces, gone. China sealed its vaults in October. The U.S. reclassified silver as a weapon. And a 15-year market veteran just issued his most aggressive forecast ever. The question isn't whether the system is breaking. It's whether you'll recognize the fracture before the collapse becomes visible. Welcome to Currency Alert. You know, my friend, if you've lived through a few market cycles, watched currencies rise and fall, seen governments promise stability while printing chaos, then you understand something most don't. The signs are always there, before the shift happens. We've been doing this long enough to know that the most important financial decisions aren't made when everyone's talking about them. They're made in moments like this. If you value analysis that treats you like the experienced decision maker you are, not like someone who needs entertainment, then subscribe to Currency Alert. Hit that button below. Because what's coming in 2026 requires the kind of perspective that only comes from watching markets long enough to know when the rules have fundamentally changed. And one more thing, we're curious, where in the world are you watching this from right now? Drop your location in the comments. Let's see how global this community really is. Now, let's examine what Craig Hemke sees that most analysts are missing. In early January 2026, a market analyst named Craig Hemke sat down for an interview that would challenge everything conventional wisdom said about precious metals. For 15 years, he had watched the silver and gold markets, studied their patterns, tracked their movements, and now he was seeing something he had never witnessed before. Silver had crossed $80 per ounce. Gold was trading at levels that made forecasters from just 12 months earlier look foolish. But Hemke wasn't celebrating, he was calculating. Because what was happening in 2026 wasn't a repeat of history. It was a fundamental break from it. In 1979 and 1980, silver spiked to $50 in about 4 months, then crashed back to $10 in just 2 months. The pattern was clear, violent, and temporary. In 2011, the same thing happened again. Silver hit $48 on October 2nd, then began a decline that lasted years. Every trader who had lived through those cycles knew the script. What goes up fast comes down faster. But 2026 was different, and Hemke had the data to prove it. On October 2nd, 2020, something unusual happened in the silver market. The spot price, the price for immediate delivery, became higher than the futures price. In technical terms, the market went into backwardation. This doesn't happen in healthy markets. It happens when there's physical stress, when people want the metal now, not promises of metal later. The backwardation deepened through October. Then it eased slightly, but it never disappeared. Even on days when heavy selling hit the market overnight, the backwardation returned. 30 cents, 40 cents, the spot price sitting stubbornly above the March futures contract. This was the signature of something most analysts refused to acknowledge. The physical metal was becoming scarce. Hemke had been tracking the numbers for years. 4 consecutive years of supply deficits, not small deficits. 800 million ounces, gone from global inventories. The mining industry couldn't keep up with demand. Industrial users were consuming more than miners could produce. Investors were buying physical metal and holding it, and governments were starting to hoard. In October 2025, China made an announcement that sent ripples through the market. Export controls on silver. The message was clear. China wasn't interested in selling its silver to the West anymore. Shortly after, the United States made its own declaration. Silver was now classified as a critical mineral, not just another commodity, a strategic resource, the kind of resource governments protect during times of tension. Hemke understood what this meant. For decades, the price of silver and gold had been determined by a system built on leverage, futures contracts, derivatives, paper promises backed by a fraction of physical metal. It was a fractional reserve system, just like banking. And it worked, as long as nobody asked for too much physical delivery at once. But now, the physical base was shrinking. 800 million ounces over 4 years, China keeping its metal, the US declaring silver critical, vault stocks declining, lease rates in London rising. Every indicator pointed to the same conclusion. The leverage was stretching. The system was designed to handle normal demand. It was never designed to handle a global scramble for physical metal, and that's exactly what was beginning to unfold. When Hemke looked at the lease rates in London, he saw stress. When he examined vault stock data, he saw depletion. When he watched the backwardation persist day after day, he saw proof. This wasn't a speculative bubble driven by traders chasing momentum. This was a physical shortage driving prices higher. And physical shortages don't resolve quickly. They don't crash in 2 months like 1980. They don't fade away like 2011. They grind higher, month after month, until either supply increases dramatically or demand is destroyed by economic collapse. Hemke knew that some analysts were calling the market overbought. Technical indicators were flashing warning signs. The monthly RSI was at levels never seen before. On a chart, silver looked like it was due for a correction. But Hemke had a different view. He didn't believe the chart was determining the price anymore. The physical market was in control now. Shanghai was setting prices overnight based on physical demand in China. When Shanghai raised margins and prices fell there, London followed. When London closed, New York responded. The tail wasn't wagging the dog, the physical market was leading, and the paper markets were following. This was the structural shift. This was why 2026 was different. And this was why Hemke was more bullish than he had ever been in 15 years of analysis. Because when physical shortages drive prices, the normal rules of technical analysis stop working. You can't chart your way out of a supply deficit. You can't draw a support line that matters when governments are hoarding strategic minerals. The only thing that matters is whether the physical stress continues. And in January 2026, every indicator said it would. On a Saturday morning in early January 2026, the world woke up to news that seemed impossible. The president of Venezuela had been removed from his country, not by a coup, not by an election, not by diplomatic pressure, by 160 aircraft and Delta Force operators, in and out, 72 hours. Marco Rubio stood at a podium that Saturday and said something that changed how serious analysts viewed the months ahead. Trump is not a game player. When he tells you he's going to do something, he means it. He actions it. Craig Hemke was watching that press conference, waiting for it all morning. He wrote down Rubio's exact words because he understood something most market watchers were missing. This wasn't just about Venezuela. This was about resources. And when governments start acting on resources with military precision, markets don't just react. They transform. For decades, politicians talked. They issued statements, wrote letters of condemnation, imposed sanctions that never quite worked. But in 2026, something had shifted. Words were becoming actions, and actions were becoming patterns. Hemke saw it clearly. The United States and China were moving onto what he called a war footing. Not necessarily military war, but economic war, resource war, the kind of competition where nations secure what they need before their adversaries can. Trump's administration wasn't hiding this strategy. Drill, baby, drill wasn't just a slogan. The United States was already the world's #1 producer of crude oil, but that wasn't enough. The administration was ring-fencing everything: critical minerals, rare earth elements, uranium, silver, copper, every resource that mattered for technology, defense, and economic independence. And China was doing exactly the same thing. In October 2025, China's export control announcement on silver wasn't random, it was strategic. China was telling the world, what we mine, we keep. The same pattern appeared with rare earth elements. The same pattern appeared with copper, which hit $5,000 per ton in London, a new all-time high. The same pattern was emerging across every resource that nations need to function in a modern economy. Hemke understood the deeper mechanism at work. For 50 years, since January 1975, the Western pricing system for precious metals had relied on one thing: leverage, futures contracts, derivatives, paper promises backed by a fraction of the physical metal underneath. It worked because the physical base was large enough, but now that physical base was shrinking. Not because mining had stopped, mining continued, but the metal being mined was no longer flowing freely into Western markets. China was keeping its production. The United States was classifying silver as critical. Other nations were watching and learning. When physical metal gets cordoned off by governments, the leverage on the remaining metal stretches. Think of it like a rubber band. The more you pull, the more tension builds. And if you pull too far, it snaps. Hemke saw this tension building in real time. Central banks had been buying gold for 4 consecutive years. Not small amounts, record amounts. This wasn't investment, this was policy. Nations were moving away from dollar-denominated reserves and toward hard assets they could control physically. Silver was following the same path. The pattern was unmistakable. East versus west. Resources being walled off, supply chains being secured, and in the middle of all this, markets that still operated on the assumption that metal would always be available. But what happens when that assumption breaks? Hemke had an answer. Prices go higher, much higher. Because when leverage stretches beyond its limit, when fractional reserve systems lose their physical backing, the paper price has to rise to reflect reality, or the system breaks entirely. And governments in 2026 were making it very clear. They would rather control resources than trust markets to provide them. Trump's team wasn't subtle about this. They talked openly about Greenland, not as a joke, as a strategy. Greenland holds rare earth deposits, strategic minerals, resources that China currently dominates. Was the United States actually going to buy Greenland from Denmark? Probably not in a traditional sense, but the conversation itself revealed the mindset. Secure resources, by any means necessary. Hemke noted something else. This wasn't a trend that would reverse. Politicians could change their minds about tax policy. They could shift positions on social issues. But when nations move into resource competition mode, when they start treating commodities as weapons, that doesn't get walked back easily. The game had changed, and once it changes, it stays changed. Some analysts argued that an economic collapse could reverse these trends. If global demand died, if industry stopped consuming silver, if investment demand evaporated, then yes, prices could fall. But Hemke calculated the probability of that scenario. The Federal Reserve was planning to cut short-term rates. The Treasury was planning yield curve control on long-term rates. Deficit spending was projected to exceed $2 trillion again. None of that suggested economic collapse. It suggested the opposite, running the economy hot, printing money to sustain it, and protecting resources to fuel it. This was the new normal. And in that environment, gold wasn't just a metal, silver wasn't just a commodity. They were monetary assets, strategic reserves, and insurance policies against the very policies governments were implementing. Hemke's forecast for 2026 was the most bullish of his 15-year career, not because he was optimistic about the world, but because he was realistic about the trends. And the trends all pointed one direction: higher prices, driven by governments, secured by policy, and amplified by scarcity. The question wasn't whether this would continue. The question was how high prices would go before something broke. There's a number buried in the United States Treasury's balance sheet that almost nobody pays attention to. $4,620 per ounce. That's the official value of America's gold reserves, not the market price, not what gold actually trades for. An accounting fiction from decades ago. And in 2026, Craig Hemke believed that number was about to become the most important figure in global finance, because someone in the Trump administration had figured out how to turn it into trillions of dollars without selling a single bond, without raising a single tax, without cutting a single program. On February 2nd, 2025, President Trump signed an executive order. The goal was to establish a sovereign wealth fund for the United States. Most people ignored it. America doesn't have sovereign wealth funds like Norway or Saudi Arabia. Those countries have massive resource revenues they need to invest. America just borrows money and spends it. But Treasury Secretary Scott Bessent had mentioned something in a speech that caught Hemke's attention. We're going to monetize the asset side of the balance sheet. Most people didn't understand what that meant. Hemke did. The United States holds approximately 8,133 metric tons of gold. At the archaic accounting price of $4,120 per ounce, that's worth about $11 billion on paper. But at current market prices near $2,800 per ounce, it's worth roughly $730 billion. Now imagine what happens if gold reaches $10,000 per ounce. The value becomes $2.6 trillion. But here's the clever part. The government doesn't have to sell the gold, they just have to revalue it. Market to market. Call in the Treasury certificates that represent the gold at $4,222. Reissue them at $10,000. And suddenly, the Federal Reserve owes the Treasury over $2 trillion. Money that didn't exist before. Money created by accounting, not by taxation or borrowing. Hemke laid out the mechanics. The Treasury revalues its gold holdings to current market prices. The Federal Reserve, which holds claims on that gold, must settle the difference. The Fed creates the money, literally creates it, and transfers it to the Treasury. The Treasury then deposits that money into the new sovereign wealth fund, deficit neutral, no new debt issued, no bond market collapse, just an accounting adjustment. And suddenly, the United States has $1 to $2 trillion to spend on whatever it wants. Buying Greenland? There were serious discussions about offering every Greenlander $1 million to vote for U.S. annexation. 50,000 people times $1 million equals $50 billion. Pocket change? If you've just created $2 trillion from gold revaluation. Infrastructure spending? Fully funded. Military expansion? No problem. All without the political nightmare of raising the debt ceiling or cutting popular programs. Hemke wasn't saying this would definitely happen. He was saying the administration had already told everyone this was the plan. Bessent said it publicly. Monetize the asset side of the balance sheet. The executive order for the sovereign wealth fund was real. The mechanism existed. The only question was timing and political will. But if Saturday morning military operations in Venezuela taught anyone anything, It was that this administration had political will. When they said they would do something, they did it. Now, here's where it gets interesting for precious metals. If the United States revalues gold to $10,000 per ounce as an accounting measure, what happens to the actual market price of gold? Does it stay at $2,800? Does it drift to $3,500? Or does the market price race toward the official accounting price? Hemke believed the latter, because once governments start marking gold at $10,000 on their books, every central bank in the world starts asking the same question. Why are we valuing our gold at outdated prices? And suddenly, you have a global gold revaluation, not driven by markets, driven by policy. But it doesn't stop there. The Federal Reserve had already signaled its 2026 monetary policy direction, rate cuts on the short end. Everyone expected that. But the more important signal was what would happen on the long end if bond yields rose too much. If long-term rates spiked, the Federal Reserve and Treasury would implement yield curve control. They would cap long-term rates by buying unlimited quantities of long-term bonds. This had been done before in history, during World War II, during financial crises. It was the ultimate monetary expansion tool, and they were preparing to use it again. Hemke connected the dots. Rate cuts on the short end mean cheaper borrowing. Yield curve control on the long end means capped interest expenses for the government. Gold revaluation means fiscal capacity without bond issuance. And deficit spending exceeding $2 trillion per year continues. All of this is extraordinarily bullish for gold. All of it devalues the dollar. All of it creates the perfect environment for precious metals to soar. But there was another layer. The jobs report coming on Friday, January 9th, 2026. The first real employment data since early September. Markets were pricing in a 50-50 chance of a rate cut in March. If the jobs report showed weakness, that probability would jump to 80% or higher. More rate cuts meant more monetary expansion. More expansion meant more dollar debasement. And on the same day as the jobs report, the Supreme Court was expected to rule on the constitutionality of Trump's tariffs from April 2025. If the tariffs were ruled unconstitutional, the government would have to refund approximately $250 to $300 billion in collected tariff revenue. Where would that money come from? More borrowing, larger deficits, or gold revaluation? Hemke saw the entire system converging on a single point. Every policy decision, every fiscal need, every monetary expansion, all of it pointed toward higher precious metals prices. Not as speculation, as mathematical necessity. The government needed money. The government couldn't raise taxes politically. The government couldn't cut spending politically. The government couldn't borrow infinitely without destroying the bond market. So the government would monetize assets. And the biggest asset on the balance sheet was gold, sitting there at $4,220 per ounce, waiting to be revalued, waiting to create trillions. Meanwhile, institutional investors were watching something else. Mining stocks weren't following metals prices. The GDX mining index was barely higher than it had been in mid-October, even though gold and silver had surged. Why? High-frequency trading algorithms. Studies showed that 80 to 90% of daily trading volume on the New York Stock Exchange was done by computers, not humans, machines. And these machines didn't care about fundamentals. They cared about momentum. When the COMEX opened at 9:30 a.m. and silver dipped in the first 2 hours, the algorithms sold mining stocks every single day, even if silver was up 50% over 3 months. If it was down 2% that morning, the machines sold. This created a massive opportunity. Mining stocks were undervalued relative to metal prices, but it also created frustration for long-term investors who couldn't understand why their mining shares weren't performing. Hemke explained it simply. The machines don't think long-term. They react to immediate price action, and until that changes, mining stocks will lag. But when the algorithms finally flip bullish, when they start buying instead of selling, the catch-up move will be violent. For now, though, the focus remained on the metals themselves and the policy architecture being built around them. Gold revaluation, sovereign wealth funds, yield curve control, deficit spending without limits. It was all being assembled in plain sight, and Hemke was watching every piece fall into place. Craig Hemke had learned something over 15 years of analyzing precious metals markets. Nobody wins when they make public price predictions. If you're too conservative, people call you timid when prices soar past your targets. If you're too aggressive, people call you a permeable lunatic when corrections happen. It's a no-win situation. But he made predictions anyway, because patterns don't lie. And in early 2026, the pattern was clearer than it had ever been. In early March 2024, gold broke out to a new all-time high. What happened next wasn't random. It wasn't chaos. It was a rhythm. Gold would rally 20%, then consolidate for 2 to 4 months, then rally another 20%, then consolidate again, over and over. like clockwork. In summer 2025, gold was trading around $3,500 per ounce. Hemke calculated the next 20% move, $40,200 to $4,300. Gold hit $40,300. Then it consolidated through October, November, and December. Classic pattern. By January 2026, gold was coiling again, ready for the next breakout. 20% from current levels would take it to $5,200. Another consolidation through summer. Then another 20% rally to $6,000 by year end. That was the roadmap, not speculation. Pattern recognition. And Hemke saw no reason why that pattern would break. The physical stress was still there. The government policies were still in place. The monetary expansion was accelerating. All the drivers that created the pattern were still active. So he made his call. $6,000 gold by the end of 2026. Silver was following a similar path, but with its own timeline. Gold had taken 21 months to double from its March 2024 breakout. Silver finally broke to new all-time highs in October 2025. If silver followed the same doubling pattern as gold, it would take 21 months. But Hemke suspected it might move faster, maybe half the time. That would put silver at $100 by summer 2026. And if the momentum continued into the second half of the year, $120 by December wasn't unreasonable. In fact, analyst Michael Oliver, someone Hemke respected deeply, had an even more aggressive target, $100 silver by the end of the first quarter, March 2026. Hemke wasn't quite that bullish on timing, but he wasn't dismissing it either, because the physical stress in silver was greater than in gold. The supply deficits were more severe, the industrial demand was more critical, and the amount of above-ground silver available for investment was shrinking faster. He called his methodology scientific. Then he laughed, because it wasn't scientific at all. It was pattern observation, trend extrapolation. But sometimes the simplest methods work best, especially when the fundamentals support them. Now there were risks. Of course there were risks. The market had been incredibly volatile. Silver moving 3% to 4% in a single day had become normal. Gold swinging $100 in a session didn't shock anyone anymore. The CME had raised margin requirements twice to account for this volatility. When you're moving 10% in a day, brokers want their clients to have more cash in their accounts. It's a safety mechanism to prevent firms from getting stuck holding losses if a client blows up. The good news was that after the margin hikes, volatility had stabilized somewhat. Still wild compared to 2023, but not as insane as late 2025. Hemke admitted he would love a few days where gold moved less than 1% and silver moved less than 2%, just to relax. But that probably wasn't coming anytime soon, because there was too much happening, too many data points, too many policy decisions, too many geopolitical events. Every day brought a new catalyst. Take Friday, January 9th, 2026. Two massive events on the same day. First, the December jobs report, the first real employment data in months. If it showed weakness, the probability of a March rate cut would jump from 50% to 80%. Markets would price in more monetary expansion. Gold and silver would likely spike. But if the jobs report was stronger than expected, rate cut expectations would get pushed back, the dollar would strengthen, and metals might pull back temporarily. Then, later that same day, the Supreme Court ruling on Trump's tariffs. Were they constitutional? Could they continue? Or would the government have to refund $250 to $300 billion in collected revenue? If the tariffs were struck down, the deficit would explode even larger. The government would need to find that money somewhere. Gold revaluation becomes more likely. Metals would likely rally. If the tariffs were upheld, less immediate fiscal pressure, but the long-term trajectory doesn't change. Either way, Hemke saw Friday as a potentially explosive day for volatility. All hands on deck, every trader paying attention, because moves of 5% to 10% were possible, depending on how the news broke. But there was something else happening that week that most people were overreacting to. Commodity index rebalancing. Because gold and silver had performed so well in 2025. Some major commodity indices needed to rebalance, sell some precious metals exposure, buy other commodities. The headlines made it sound terrifying. $4 billion in gold, futures selling coming. Hemke did the math. $4 billion in gold, futures equals about 10,000 COMEX contracts. The average daily volume on the COMEX is 150,000 to 200,000 contracts. And the selling wasn't happening all at once. It was spread over 5 days. So we're talking about 2,000 contracts per day. That's 1% to 2% of normal daily volume. Completely manageable, not a crisis, not a crash trigger, just normal market mechanics. But Zero Hedge wrote a dramatic article about it. Some banks sent scary emails to clients, and suddenly it became a thing. Hemke called it completely overrated. And he was right. By Thursday, gold had already bounced back into positive territory. The rebalancing fear was a nothing burger. Silver had a similar story. About 10,000 silver contracts over 5 days. Daily volume in silver is 100,000 to 150,000 contracts. Again, a small percentage of normal activity, not a market-moving event. The real story wasn't the index rebalancing. The real story was that physical markets were setting prices now, not paper markets. When Shanghai raised margin requirements overnight, silver in China dropped 6%. That weakness carried over to London. By the time New York opened, silver was down 5%. Was it because of fundamentals? No. It was because of margin calls in Shanghai, a technical event in one physical market. Rippling through global pricing. That's how you know the physical market is in control. When margin changes in China move prices globally, the tail isn't wagging the dog anymore. The physical demand is leading, and paper markets are following. This was the most important insight Hemke offered. Forget the technical indicators. Forget the RSI readings. Forget the Elliott wave counts. Those tools assume that price is determined by charts. But in 2026, price was being determined by physical supply and demand. And you can't chart your way out of an 800 million ounce supply deficit. You can't draw a support line that matters when governments are hoarding strategic minerals. The only question that matters is, does the physical stress continue? And every indicator said yes. China wasn't reversing its export controls. The US wasn't declassifying silver as non-critical. Central banks weren't selling their gold. Deficit spending wasn't stopping. Monetary expansion wasn't slowing. All the structural drivers remained in place. So Hemke stood by his forecast. $6,000 gold. $120 silver. By the end of 2026, not because he was a permabull, not because he was trying to pump the market, but because the trends that created the current environment were accelerating, not reversing. He had been doing this for 15 years, long enough to recognize when noise is just noise, and when signal is actually signal. In 2025, at the start of the year, everyone said gold at $3,100 was impossible. Silver at high 30s was lunatic talk. The dollar was soaring. Doge budget cuts were coming. Gold was in a bubble at $2,600. Hemke predicted 10% gains for gold and 30% for silver. People called him crazy. Gold ended the year up 27%. Silver ended up over 50%. Then, in December, he got an email. Someone told him he was an idiot for only predicting 10% and 30%. He should have seen the massive rally coming. That's when Hemke realized it really is a no-win game. But he was going to keep playing it anyway, because someone needed to cut through the hyperbole. Someone needed to separate the legitimate analysis from the conspiracy theories, from the claims that J.P. Morgan had 700 million ounces of silver, from the stories that exchanges nearly failed on Thanksgiving, from the panic about index rebalancing, all easily disprovable, but repeated endlessly by AI-generated content and social media. Most of what people worry about doesn't matter. And most of what actually matters, people ignore until it's too late. The physical stress in silver and gold markets matters. The government policies on critical minerals matter. The monetary architecture being built for gold revaluation matters. Everything else is noise. And in 2026, the signal was louder than it had ever been. Hemke's final message was simple. Stay grounded. Ignore the hype. Watch the data. Follow the trends. And understand that what's happening in precious metals isn't a bubble. It's a structural shift, one that's just beginning, because when governments treat resources as weapons, when central banks hoard gold as monetary insurance, when physical shortages drive pricing instead of paper contracts, the old rules don't apply anymore, and the new rules favor much higher prices, $6,000 gold, $120 silver by December 2026. Not a prediction, a pattern, and patterns don't lie.